Section 1. Introduction. Myth, Fact, and the World of Money. Myth. A few secret people control all the money behind closed doors. Fact. Many rules and many institutions shape money. Some things are public. Some happen in meetings behind closed doors. This simple contrast sits at the heart of our global financial system. It feels complex and distant from everyday earning, spending, and saving. Yet the decisions made here touch everyone. Price of bread, interest rate on a car loan, availability of jobs in our towns. Not a handful of shadowy figures, but not entirely transparent either. Section 2. The foundation of finance. How your local bank works. Before we can understand the complexities of global finance, we must start with the basics. It all begins with the bank on your street corner. Banks are a fundamental part of our daily lives. We use them to keep our earnings safe. We rely on them for loans to buy homes. We rely on them to start businesses. The basic model is simple. You deposit your money into a savings account. You deposit your money into a checking account. The bank promises to keep it secure and available for you whenever you need it. In exchange for holding your money, the bank might pay you a small amount of interest. This relationship seems straightforward, but it is only the first part of the story of how banking truly works. The bank does not simply store your money in a vault or cover its own costs for staff and buildings. Instead, the bank lends a large portion of the money you deposit to other people and businesses. This is the core of its business model. Someone who wants to buy a car might take out a loan. A family might get a mortgage to purchase a house. A business owner might borrow to expand their operations. The bank charges these borrowers a higher interest rate than the rate it pays to you, the depositor. The difference between these two rates is the bank's profit. This process of taking in deposits and making loans is what keeps money flowing through the economy. This system is known as fractional reserve banking. The name sounds technical, but the idea is simple. The bank is only required to keep a fraction of its total deposits in reserve. The rest can be loaned out. For example, if the reserve requirement is 10% and you deposit $1,000, the bank must keep $100 on hand. It can then lend out the remaining $900. This system works because, on any given day, only a small number of depositors will come to withdraw their cash. The bank assumes that most of the money will stay put, allowing it to use those funds to generate income through lending. However, this is also where the first element of risk enters the picture. If a large number of depositors suddenly lose confidence in the bank and rush to withdraw their money all at once, it can create a bank run. Since the bank has loaned out most of its deposits, it will not have enough cash on hand to pay everyone back immediately. This is why governments create deposit insurance programs, like the FDIC in the United States. These programs guarantee that your deposits are safe up to a certain amount, even if the bank fails. This guarantee helps maintain public confidence, which is the invisible glue that holds the entire banking system together. Section 3. The creation of money, more than just a printing press. One of the most surprising facts about modern economies is how new money is actually created. Most people imagine a government-run printing press churning out stacks of fresh banknotes. While physical currency is indeed printed by a central authority, the vast majority of money in the economy is created digitally by commercial banks. This happens every time a bank issues a new loan. When you borrow money, the bank does not take it from someone else's account. It creates new money in that moment. Let's walk through a simple example. Imagine you go to your bank and are approved for a $10,000 loan to renovate your kitchen. The bank does not pull $10,000 in cash from its vault. Instead, it simply adds a digital entry of $10,000 into your bank account. At that instant, the total amount of money in the economy has increased by $10,000. That money did not exist before the loan was made. You can then spend this new digital money by writing checks, using your debit card, or transferring it to your contractor. This process of money creation through lending is happening constantly on a massive scale across the entire global banking system. This ability for commercial banks to create money is what fuels economic growth. When banks are willing to lend, businesses can invest in new equipment and hire more workers. Families can buy homes and cars, stimulating demand for goods and services. This expansion of the money supply helps the economy expand. However, this power also comes with significant risks. If banks create too much money by lending too aggressively, it can lead to an oversupply of money chasing a limited amount of goods and services. This is a classic recipe for inflation, where the value of money decreases and prices rise for everyone. Managing this process is a delicate balancing act. The amount of money that banks can create is not unlimited. It is constrained by several factors. These include the reserve requirements set by the central bank, the amount of capital the bank holds, and the demand for loans from credit-worthy borrowers. If people and businesses are not confident about the future, they will not want to borrow, and money creation will slow down. Section 4. The conductor of the orchestra. Understanding central banks. If commercial banks are the individual musicians in the economic orchestra, then the central bank is the conductor. A central bank is a unique and powerful institution that sits at the top of a nation's financial system. It is not a bank for ordinary citizens. You cannot open a checking account or get a car loan there. Instead, its customers are the commercial banks and the national government. The most famous central banks, the US Federal Reserve, the European Central Bank, the ECB, and the Bank of Japan. Their primary mission is to maintain economic stability by managing the nation's money supply and by overseeing the banking system. One of the central bank's most important tools is its ability to set the main interest rate for the economy. This is the rate at which commercial banks can borrow from each other or borrow from the central bank itself. By raising or lowering this key rate, the central bank influences the cost of borrowing across the entire economy. Higher mortgage rates, higher credit card rates, higher business loan rates. The central bank also has the exclusive authority to issue physical currency, the bills and coins in your pocket. More importantly, in the digital age, it creates electronic money. It uses that electronic money to buy government bonds or to buy other assets from commercial banks. This process, known as quantitative easing, injects new money directly into the banking system, further encouraging lending. Beyond managing interest rates and the money supply, the central bank acts as a lender of last resort. During a financial crisis, fear can spread quickly. If people worry their bank might fail, they may rush to withdraw their funds. As we saw, this can cause even a healthy bank to collapse. In such a situation, the central bank can step in and provide emergency loans to solvent but illiquid banks. This critical function prevents a panic at one bank from spreading and avoids a chain reaction that could bring down the entire financial system. The actions of central banks during the 2008 global financial crisis are a prime example. They provided massive support to prevent a complete economic meltdown. Now we move from the national level to the global stage. After the devastation of World War II, world leaders gathered to design a more stable international economic system. They created two key institutions: the World Bank to finance reconstruction and development, and the International Monetary Fund, the IMF. The IMF's main job was, and still is, to act as a sort of global economic medic. Its purpose is to ensure the stability of the international monetary system, the system of exchange rates and international payments. It acts as a financial backstop for its member countries. Imagine a country, let's call it Country X, is facing a severe economic crisis. Perhaps the price of its main export has collapsed, or investors have suddenly pulled their money out. The country is running out of foreign currency reserves like US dollars. It needs to pay for essential imports like food, medicine, and fuel. Its own currency is plummeting in value. In this scenario, the government of country X can turn to the IMF for help. The IMF can provide a large loan of foreign currency to stabilize the situation. This financial lifeline gives the country breathing room to get its house in order. The money the IMF lends does not come from thin air. It comes from a pool of funds contributed by its member countries. A country's contribution, its quota, determines both its funding share and its voting power within the IMF. An IMF loan is not a simple handout. The financial assistance comes with strings attached. These strings are known as conditionalities, or a structural adjustment program. The logic behind them is straightforward from the IMF's perspective. If a country is in a crisis so deep that it needs an emergency loan, its existing economic policies are likely part of the problem. To ensure the country can eventually repay the loan and achieve sustainable growth, the IMF requires the government to implement specific policy reforms. These are intended to fix the underlying issues that caused the crisis in the first place. These conditions often fall into a few common categories. Cut public spending, reducing subsidies on fuel, reducing subsidies on food, shrinking the size of the civil service. Increase revenue by raising taxes, value-added tax, VAT. Privatization of state-owned enterprises, utility companies, airlines. Devalue the country's currency. While these policies are designed to restore fiscal balance and economic stability, they can have severe and painful consequences for ordinary citizens. These austerity measures can lead to job losses and a decline in living standards. This is why the arrival of the IMF in a country is often met with public protests. Supporters argue the medicine is necessary. Critics argue one-size-fits-all prescriptions can worsen inequality and harm development. While the IMF often operates in the public spotlight during a crisis, there is another, much quieter global financial institution that is arguably just as important: the Bank for International Settlements, the BIS. Established in 1930, the BIS is older than the IMF and the World Bank. It's often called the central bank for central banks. Based in Basel, Switzerland, it's owned and controlled by the world's major central banks. Its purpose is not to lend to countries in crisis, but to serve its members, the central banks themselves, and to promote stability through cooperation. Think of the BIS as an exclusive club or private meeting place for the world's most powerful central bankers. They regularly meet in Basel. These meetings provide a confidential forum to discuss the state of the global economy, share insights, and coordinate policy. The BIS publishes research, but the specific conversations remain private to allow frank discussion. One key function of the BIS is hosting committees that set global banking rules, most famously, the Basel Committee on Banking Supervision. It develops standards like the Basel Accords, Basel I, Basel II, Basel III, specifying how much capital a bank must hold against losses. They are not legally binding, but national regulators are strongly encouraged to adopt them. The BIS also acts as a bank for its members, holding and managing reserves and facilitating transactions like currency swaps, providing the plumbing and wiring of global finance. The idea that important decisions are made behind the curtain is central to the public's suspicion of institutions like the IMF and BIS. And there is a kernel of truth to this. The hidden mechanisms are less about conspiracy and more about the complex nature of power, influence, and expertise. First, there is the issue of unequal representation. At the IMF, voting power is tied to a country's financial contribution. This means the United States and some European nations hold effective veto power over major decisions. Second, negotiations are often opaque. Final agreements are published, but the public rarely sees the trade-offs or alternatives. That fuels suspicion that deals serve foreign creditors or corporations rather than citizens. Similarly, BIS closed-door meetings enable candor but limit public input. Third, a shared intellectual framework can produce groupthink, free markets, deregulation, austerity, making dissent hard to hear. Finally, The private financial sector's influence is significant, lobbying rules that affect compliance costs. That dynamic can produce regulation favorable to industry over the public, regulatory capture. The decisions made in the boardrooms of Washington and Basel may seem abstract, but they create powerful ripple effects that reach into the wallets and lives of ordinary people everywhere. The most direct connection is through interest rates. When a central bank, influenced by discussions at the BIS, decides to raise its policy rate to fight inflation, that decision does not stay in the financial realm. Within weeks or months, the interest rate on your credit card debt will likely go up. If you have a variable rate mortgage, your monthly payment could increase significantly. A small business owner seeking a loan may delay hiring due to higher costs. IMF conditions can be more immediate. Subsidy cuts raise fuel prices. Governments may lay off clerks, nurses, teachers. Unemployment surges. An increase in VAT raises the price of groceries, clothes, and other essentials. For a family already struggling, these combined shocks can be devastating, but influence is not always negative. Coordinated rate cuts, as in 2008 and 2020, helped save jobs and prevent deeper collapse. An IMF loan can restore critical imports, stabilize the currency, and prevent hyperinflation, wiping out savings. The global financial system is an interconnected web. Choices in one region shape credit, prices, and opportunities elsewhere. A European banking rule can influence South American credit. China's currency policy can affect U.S. electronics prices. We have journeyed from the local bank to the global stage, demystifying the roles of central banks, the IMF, the BIS. We have seen the financial world is not run by a secret cabal, but by a complex system of rules, institutions, and power dynamics. Some operations are public, others happen behind closed doors. These institutions can stabilize economies, or disrupt them. Global finance can feel technical and intimidating, but its core principles are within anyone's grasp. Power here is real, yet diffuse and constrained. The IMF imposes conditions only when countries ask. The BIS proposes standards, not laws. Influence from wealthy nations, intellectual consensus among elites, and private sector lobbying shape outcomes. Acknowledging this is the first step. Push for a more transparent, equitable, accountable system. Here are 3 simple things to start. 1. Read one summary. Search for a plain language IMF country program or a BIS annual report highlight. 15 minutes for the basics. 2. Check your financial exposure. If you have a variable rate loan or credit card debt, calculate how a 1%, 2% rise changes payments. 3. Ask leaders simple questions. When trade deals or loans are negotiated, write to your representative or attend a town hall. What are the main conditions? How will this affect jobs and prices? This journey is the first step to empowerment. You'll be equipped with knowledge, not fear. Set aside thrilling secret cabal tales. Focus on mechanics of money and power. We've peeled back layers. How banks create money, what central banks do, and how the IMF and BIS shape outcomes. An informed public is the best check on power. The system is human-made, so humans can understand, question, improve it. From global boardrooms to your household budget, the links are real and knowable. If this helped, share it with someone who needs clarity today.